Hey everyone, welcome to the Getting Sharpe podcast presented by Omega Point. I'm Omer Cedar, CEO and founder of Omega Point, and we've created this podcast to help our investor community really better understand some of the most relevant topics impacting institutional investors in the current market environment. Today, I'm excited to be joined by Pouya Taaghol, founder and CEO of Big Data Federation. And Pouya is going to help us provide a view on fundamental forecasting and how scientific approaches are really reshaping traditional analysis. Many investors, obviously in our community, are grappling with the challenges of accurate fundamental forecasting. This is what they do. It's their raison in many cases, but there are limitations, right, to the improved forecasting, and what we've seen in the market is only become more complex. Now, these issues are certainly at the forefront, and we are during earnings season, so it is a good time to sort of talk about these issues. So really, we're going to be exploring Big Data Federation's scientific approach. It's how their methodology really creates repeatable and scalable forecasts, as well as understanding the inputs that's driving their models. Finally, just understanding how investors can leverage all of these insights in their investment process, and certainly in the current market environment. So again, with that, it is my pleasure to introduce Pouya. Thank you so much for joining me today.
Thanks so much for having us. Great. And we'd love to, hopefully we're going to have fun.
Absolutely. I wanted to start with the fact that you really have a unique background relative to other fundamental forecasters out there. And I really just wanted to start by asking you to share to our audience a little bit about your background and how you came into working in the space.
Yeah, thanks. My background is, PhD electrical engineering. I was CTO of Intel Wireless, Cisco, similar position at a bunch of wireless companies. My background is a lot of digital signal processing. It was at the time, we were moonlighting about 10, 15 years ago. We got interested in, what now people call it alternative data. We had no idea. We were just trying to count cars in parking lots and figure out what was the revenue of Home Depot and Lowe's. And we actually did it. And then we realized, my God, there's a lot more to do. And accidentally at that time, a friend of mine moved to a hedge fund, and he said, oh yeah, we will be interested. And then I had a customer, and then we started a company selling those forecasts. The approach we took was basically, we tried to really, finding the asset price is very complicated. It has many factors involved in it. But we got very interested in basically the fundamental part of these companies, which we thought it's not random. What Amazon makes or what NVIDIA makes, it's really not random. There's a series of things that has to happen for them to hit those kind of revenues, or up or down, whichever direction it goes. So we started basically analyzing data like the traditional way, the analyst way, the spreadsheet way, actually. Then we grew it into something a lot more sophisticated, where we basically, we call ourselves forecasting fundamentals scientifically. Forecasting is very, very hard. It's very, very hard. And by no means we have solved the problem. It's going to be an age-old problem. It's going to keep growing. It's going to get enhanced. But the important thing is, how are things connected together? And we realized that is truly a big data problem. And the approach we took was very, very untraditional in many ways. We basically tried to find good data, which is not necessarily traditional panel data, and it's not usually the government data either. There are a lot, fact finding. Number one, you got to have the right input. So the approach we took was basically, we tried to look at it scientifically, an engineering model, where we started to connect things. And we were lucky from day one. There were people that had interest in what we were doing. Right now, we're covering over 1,400 companies of all sizes, of all industries. Yeah, so the approach was not to follow the tradition, because we believe that innovation comes from usually a disruption from outside, not quite from within. So, and we were just lucky being in Silicon Valley and all that. We hardly bump into any hedge fund here or anything. That's really the background of where we ended up here. It was just purely curiosity and interest.
Yeah. Well, that is what makes it really kind of interesting, is that in some ways, right, you came in from a different industry and stumbled into one that has been operating in a particular way for many, many years. And we know that sometimes innovation comes at the intersection of multiple disciplines, right? Or looking at something in one industry and applying it to another. And it really feels like this is probably the case. Maybe you can expand a little bit about what do you think is sort of what are some of the challenges that you saw early on, right, with the traditional approaches to forecasting on fundamentals? It sounds like you said you were working on spreadsheets. You were trying to come up with sort of intuition probably for a lot of these companies and how to forecast them. You were probably looking at other estimates that were coming in from the market. So what was the kind of the challenges that you faced? And then if you could also talk about then, what did you do to kind of address some of those challenges, using your approach?
Yeah, I mean, the biggest challenge, I mean, there's so many challenges in forecasting fundamental. First of all, it's not a sexy data science project. It's really hard to convince data scientists to come and work on something that happens 4 times a year. That's just not enough, test data, they call it, right? And the other big challenge is these companies keep changing. It's not the same thing. I mean, you look at NVIDIA 4 or 5 years ago, it was like less than 50, around 50% was gaming. Today, gaming is 9%. Data centers, almost 90% of the revenue is gaming now, the data center now. So completely changed. And we're not even talking about a decade, right? And it's not just in the tech, you can actually also see it in a lot of other industries, a lot of staples, that they keep acquiring each other and their business changes, right? And people know Coca-Cola, Pepsi-Cola, and all this soft drink companies. But boy, they sell a lot of snacks. So you and I always, probably every day, are using their snacks. And so their business also changed. So business changed. So that's one huge problem that is out there. And secondly, it's just the reliance of that alternative data, whatever panel data people call it, right? I mean, alternative data is big, but panel data that people, we used a lot of those to actually try to figure out how to extract a signal to predict the fundamental of these companies. There are huge problems with those. So first of all, they have limited demographics, and it's also changing. If you're a panel collecting emails or whatever, right? You're at the mercy of the regulation of the email companies, all kind of things. So your panel population keeps changing. There's all kind of sampling errors they do. There's all kind of extrapolation they do. And they have also methodology changes. All of a sudden, their historical data changes. Something happened, and then they have to change their historical data. It was just going after that was very, very tedious for us. And sometimes you find good things too. I mean, it's just, we wanted to do something at very large scale. So, so that was not the scalable thing. So we tried to find facts. As I was saying, finding facts is actually pretty difficult. People think that you go get government data and publish this retail sales. That retail sales is just a survey. It's just a survey, and it gets 3 or 4 revisions. Actually, look at the final revision. The first release almost have nothing to do with each other. It's just, it's not exactly a fact. So finding fact is hard. So we relied, we figured out, okay, companies are connected to each other. So they report, okay, that's a fact. This company reported their sales. For example, AMD reports the sales. Well, AMD is connected to NVIDIA. NVIDIA is the one that reports last. But, then there's all these chip makers that report and power chips that are also quite relevant to NVIDIA. But we don't do that at manually. So it's done at a very large scale. The important thing is, I would say high quality data, factual data is very difficult. But there's a lot of data, factual data out there too. The companies themselves report. There's a lot of companies actually report their sales monthly, some weekly. If you look at the railroads, every week they publish the rail loads of their cars across the U.S. Very, very detailed. There's a lot of associations that they publish, Semiconductor Association, RV Association, just name it. These are factual numbers that they actually happen. So finding facts, good data is very important. Modeling is the absolute difficulty in doing this, meaning how do you connect these companies, these metrics together? And third one, I would say the scalability, which is related to that. Is that scale, right? I mean, if you just have a model that can predict Apple, okay, that's cool. It's a big company. But, to really make money in the industry, you really have to have a lot more broader, forecast to do this. So basically, in a nutshell, it's basically those three, finding good data, modeling properly, and doing it at the scale. So these are really the toughest challenges.
And in terms of, I think that what's great about this, obviously, like you said, it does scale across many companies, and sort of to give maybe a palpable example, right, to the audience, they might be interested in, okay, I mean, sounds like a very robust, large scale data and scientific project, but let's bring it down to maybe a company or two. If you can give us a use case or an example of how these things sort of tie together, from, like you said, being able to find factual data coming from either industry or government, the connections between different companies. Is there, one or two examples you share with the?
Yeah,
With
I'll
the
give you two. I'll give you two or three from different industries. So it's actually pretty entertaining, when you do that. It's actually, these metrics are not picked by us. The machines did that, but we can totally connect to it. For example, when you want to a DRI garden, gardens, and I think it's the Olive Garden chain, and that restaurant chain is kind of casual, smart casual kind of restaurant. How do you predict their sales, right? So, if one of the things that the machine found was there's a huge correlation between their sales. And that's correlation. A key prime driver of their sales was basically apparel gross income. So apparel industry. So basically the machine goes and aggregates these companies that are in apparel, creates an index for them. And a lot of other apparel companies, et cetera, and a lot of other metrics. So for that particular example, there's about 150 different metrics used to predict just the sales of DRI. And we wonder, why is it picking that? Why? I mean, because a lot of people would immediately go, so give me some foot traffic. Let me see how many people that had their GPS on or whatever, their Bluetooth on, and I kind of triangulated it. But this one actually picked something interesting. So, and we wonder why that is. And well, you can say, why, if you look at the apparel gross income, the reason it goes up is because people are buying expensive clothes. Why would they buy expensive clothes? They're not buying it to sit at home. They're buying it to go out. And what do they do when they go out? They go eat. So all of a sudden, we kind of knew that, right? And a lot of the time, analysts kind of mention that qualitatively, but now it takes it to the quantitative level across the board. And actually, another thing, so let's say Expedia travel, right? They make most of the money from hotel, some from airlines, some from flights and all that, mostly hotel. The same with booking.com. It does also the same thing. It does take apparel, but number one above that is shoes. It picks the shoes vendors, the shoes companies as an input. And then I started to think, wow, I'm much more likely to buy a new shoe when I'm traveling. Either I'm traveling for business or leisure. I need something comfortable to walk in, for example, right? And you can actually start to think your pattern now every time you want to go on a business trip or on a vacation, you're probably buying some new shoes. They go somewhere and all that. So again, these are just one or two metrics, right? And let's now take it to another level. Let's say NVIDIA. Okay, this is best performing large cap, I think, is it? Yeah, maybe. I mean, this year, it's just astonished. Such a size growing at 400-500% earnings year over year. I mean, that's insanity. So how do you keep up with that, right? So we cannot. So machines does. So one of the key metric it takes is power chips gross income. So why power chips grow income? Again, data center, which is now the main business for NVIDIA, those AIs consume a lot of power. They need a lot of power chips. They need the expensive power chips, which impacts the gross income of those companies. It's something like NVIDIA also reports way after all their competitors. It reports after AMD, it reports after Intel. All of those also go in as input to the analysis. And then the other thing that it does, the system also looks at the capital market. It's insane. It basically looks and see, how's BlackRock doing on their profit? BlackRock's profit is linked to the stock market action, which means capital market availability in general. It picks all of these. Now, why is this important is that this right now forecasts better than the analysts by far, much more consistently. Not always, not everything. It's far more accurate than what's out there. And it's also independent. In other words, it is not taking someone else's number and basically trying to stay close to the consensus so we don't become unfamous. That's what a lot of analysts do. They all want to have a tight range close to the honeypot. So they just don't want to get too far away from that, right? So these are a few examples. I hope it was helpful. And we do it every day. There's a lot of information comes in. Our forecasts are updated every single day.
Yeah. No, I mean, it's very helpful. And I think, obviously when people hear machines and they're hearing lots of data and lots of forecasting, having that intuition to understand this is in essence, what it's doing is uncovering things that are highly intuitive and often talked about in a qualitative manner, right? I mean, what you're doing is you're systematically and in large scale quantifying, right, those relationships. And I think that that's really powerful. And it sort of leads me to the sort of kind of the next question, which naturally is there's a lot of information that you're gathering. There's a lot of information that you're using both as inputs and maybe even intermediate, right, steps to do your final forecast. I guess, how can investors use your data, right? What would you recommend? I know that obviously you're generating, and this is part of what you're producing that investors can use. Can you kind of walk us through kind of high level sort of, you don't have to go to all the details of the data set, but just sort of what are the kind of categories of information that you think are helpful for investors?
So that's really a great question. Fundamental is very fundamental. How do I say? While price of assets could move for various reasons, effectively what drives an asset price is its fundamental ability to produce earnings. In the case of stock market, there's a lot of assets, just precious. In terms of producing assets, it's about producing the earnings. So one important thing is if people are long shorts, right? You actually want to know that that company is actually doing well to your estimations. Whether you are interested in on the very event of the earnings where you may want to hedge, you may want to double down. That comes handy. And also in the case that you have long-term investment and you want to double check to see if your hypothesis is correct. Just one more data point, which is in terms of an independent forecast. So this is a few examples of the fundamental plays that people are doing. We produce actually the sales forecast, the margins. We actually produce various metrics in the income statement. And our machines also give a confidence level. Our confidence level could change through the time. So we kind of have confidence, good, or we don't have confidence when you actually see our numbers live. So you can actually also take that into an account because we're not correct all the time. It's just an aggregation.
No, that's it's a great sort of overview. Obviously, without putting too much of a plug, obviously the data is available also on Omega Point today, and we're excited to have all that. And again, the ability to aggregate it actually at the industry, or sort of kind of a sub economy level is really, really interesting, and one where I think definitely complements, right, looking at just individual company forecasting. I guess that's actually a potentially good place to sort of kind of maybe end up today with our audience. I mean, you certainly are seeing so much data, right? Not on, again, on individual companies, but you're able to aggregate them, and you're looking ahead. Just what does your data say today about the U.S. economy? In the near term or the medium term, anything that you can kind of offer as wisdom or guidance for our investor base would be great.
The U.S. economy seems to be totally fine. We see very little chance of recession for the next 6 months, at least. The earnings are quite good. We're continuing to expect pretty consistent growth on the earnings. Again, the earnings growth is not coming from everywhere. It's nothing new. Historically, only 17% of S&P have delivered 70% of earning growth of the S&P, and that has not changed. So that one is important. Inflation is kind of hovering around where it is. It's, the headline is kind of cooling up because of oil a little bit, but there are metrics in the core that is coming back up, like the medical. And we believe that actually the high interest rate is causing certain certain inflation right now, especially in the housing. High rates basically have crippled existing home sales and a new construction of homes in general, which basically limited the supply while the population is still growing. So the rents are on high demand because people cannot buy. So I think if rates kind of slows down or go a little bit lower, it could actually help elevate the real estate part, which is a big chunk of the CPI. It's just, 30-something percent CPI. So it's huge. Also, the rates right now, as of last week, we did a calculation. It's about, there are about $7.4 trillion of debt held by S&P 500 companies. There are 90% of those are long-term, about 10% short-term debt. You can imagine they're paying interest. So basically, the interest they pay is right now is about, equal to 26% of their net income. In other words, if the rates go to zero, their net income goes up by 26% with no effort. But obviously, it's not going to go to zero, the interest rate. But if the rates go down, that is another boost to the earnings without much headache, without much effort. So in general, all good. There's always geopolitical risks that we're monitoring, right? But right now, U.S. economy continues to outshine the rest of the world in terms of strong regulations, very, very good system, and we have very healthy consumers. Job market is almost fully employed. The consumer spending is slowing, but it's going back to where it used to be. So it's normalizing. So all in all, probably as good as it gets right now.
I hate to use those words, but what you call
Who knows, right? Still, we don't know. But right now, the data shows good. It's positive.
well, I think that's why people need to access your data on a daily basis and stay informed and see
Keep
when.
changing. Keep changing. Yeah, absolutely.
It was such a pleasure having you
Thanks.
on the podcast. I think that we've covered a lot of ground, and certainly for the viewers, if you have any questions, feel free to come back to us, or Pouya, and we look forward to talking to you again soon.
Thanks, everyone. Thanks a lot.
Thank you.